There are two ways that you can tap into your 401k to buy real estate, a loan or a withdrawal. In this video, I'm gonna walk you through each strategy, go over the pros and cons, and then share some insights on when using your 401k for real estate might actually make sense. Let's start with strategy number one, the 401k loan. So here's how it works. You can borrow up to 50% of your vested account balance with a maximum cap of $50,000. You repay that loan into your 401k over the next 5 years with interest through paycheck deductions. So kind of similar to how you make 401k contributions. As long as you pay it back within the required time frame, there are no taxes or penalties on the loan. Now, before you get too excited, you do need to figure out if this is even an option for you. So what you need to check is, number one, does your plan allow for 401k loans? Not all plans allow for this. Most do, but not all. To find out, you can log into your 401k provider's website, navigate to plan documents, locate the summary plan description, also called the SPD. In that, you're going to want to look for the section titled loans, and this will explain whether or not loans are allowed and any specific rules surrounding those loans. Second thing you need to determine, this should be an easy one, are you still employed by the company sponsoring the 401k? So 401k loans are only available for accounts with your current employer. If you have an old 401k from a previous job, you're not going to be able to take a loan from that account. To take a loan, you have to be actively employed by the company sponsoring the 401k. And then finally, you need to figure out how much can you actually borrow. So like I said, loan amounts are capped at the lesser of 50% of your vested account balance or $50,000. So for example, if your vested account balance is $120,000, you can borrow up to $50,000, even though 50% of your balance is $60,000. You hit that $50,000 cap. Now for balances below $20,000, some plans actually allow you to borrow up to $10,000, even if that exceeds 50% of your balance. For example, if you have a $15,000 vested account balance, you may still be able to borrow up to $10,000. Now let's talk through some of the advantages of using a 401k loan to purchase real estate. The obvious one is no taxes or penalties. So since it's a loan and not a withdrawal, you won't pay taxes or the 10% early withdrawal penalty as long as you repay it on time. You also have pretty reasonable interest rates with 401k loans. It varies by plan, but it's usually the prime rate plus 1%. For example, with today's prime rate of 7.75, your loan rate would be 8.75%. Now that's likely higher than what you get with a conventional mortgage, but probably lower than you'd get with a personal loan or a HELOC. And then that interest that you pay, it actually goes back into your 401k account. So rather than paying a bank interest, you're actually paying interest back to yourself. Now there is a downside to that, which I'll get to in a little bit. 401k loans also have the advantage of not impacting your credit. You don't even have to go through an underwriting process. The employer has to approve the loan, but there's no credit check. A loan doesn't show up on your credit report. Lenders won't look at it when figuring your debt to income ratio, and really doesn't impact your credit at all, even if you don't pay it back. Which leads me into the disadvantages, which is, well, what if you can't pay it back? If you don't repay the loan within the time frame, it's usually 5 years, although some plans do allow 10 years for the purchase of a primary residence, the remaining balance will be treated as a taxable distribution, which is going to be subject to taxes and a 10% penalty if you're under age 59 and a half. So if you have a $30,000 401k loan and you don't pay that back on time, that's going to show up on your tax return as $30,000 of income. So that could mean paying an additional $9,000 to $10,000 in taxes when you go to file your tax return. So do not take out a loan unless you know that you can pay it back. Just general good rule of thumb. Now, the employer automatically takes it out of your paycheck, so there is sort of a forced repayment element to it, and that reduces the risk of non-repayment. But that brings us to another complication or disadvantage to the 401k loan, which is if you leave your job, whether voluntary or involuntary, that loan becomes due immediately. Now, some plans do give you 30 to 90 days to repay, but if you can't repay within that time frame, it's going to be treated as a taxable distribution, meaning you either have to write a check to pay back the loan in a very short time frame, or it'll be counted as a taxable distribution, in which case you're going to have to write a check to the IRS. And that is one of the biggest risks of 401k loans because it's really outside of your control. So just know that that is a possibility and a risk. Another disadvantage worth considering is that the money taken out of your 401k for the loan is no longer invested in the market. So you miss out on any potential market growth occurring during that period. Now, this could potentially be offset if you're using those proceeds to buy another investment like real estate. Now, there's no guarantee that it's going to do better or worse relative to the market. We won't know that until after the fact. But ideally, if you're taking this money out of the market, it's preferable that you use that money to buy another investment, another appreciating or cash flowing asset. Another disadvantage that people may not think about very often is the double taxation of interest. So I talked about how you're paying back interest into your 401k. So you're essentially paying interest back to yourself. The downside to that is that you're paying back that interest with dollars that have already been taxed. And then when you go to withdraw the money in retirement, that interest portion is going to get taxed again. So the interest portion of your 401k is actually getting taxed twice. Now, if it's a short-term loan, probably not a big deal in the grand scheme of things, but it's just something to be aware of. And then on the topic of interest, unlike mortgage interest, the interest that you pay on a 401k loan is not tax deductible, even if you're using it to fund the purchase of an investment property, which makes sense because, again, you're basically paying yourself interest. So there are a lot of things to consider here when it comes to using a 401k loan to purchase real estate. Generally speaking, the 401k, I think, should be one of the last places you get funding for the reasons I mentioned previously. But in some situations, it does make sense. The first place it makes sense is when you're purchasing an investment property. Usually makes more sense to use a 401k loan to buy an investment property rather than a home purchase. If you're using it to buy a rental property, for example, you're at least using that money that you took out of the stock market to invest in another asset, another hopefully cash flowing asset. That contains its own set of risks, like with any investment, but your money is still invested. It's just in another asset class. Now, a home is less of an investment while you're living in it compared to a rental property. Yes, you're still building equity. It's still an asset, but you're not receiving rental income from that asset. The 401k is designed to fund your lifestyle while you're no longer working. And a rental property can help accomplish that goal. Now, a primary residence, on the other hand, may be something that eventually funds your retirement, but you're always going to need a place to live. So not necessarily the best vehicle to depend on for retirement income. I'm more inclined to use a 401k loan to buy an investment property than a primary residence. Other situations where using a 401k loan to purchase real estate may make sense. Let's say you need quick access to cash, but you know that you're going to be able to repay that loan in a short period of time. Here's a real life example. Client had their annual bonus coming through at the end of the year in December. In September, they came across an incredible deal on a lakefront property that they wanted to convert to an Airbnb. They were going to have plenty of cash in 3 months' time, but at the moment, they needed to make an offer and they were $40K short. So they each took out a loan from their 401k, got that within 1 or 2 weeks. They were able to make a cash offer on that property. And then when they got the bonus at the end of the year, they paid back the 401k. So it was only outstanding for a few months. So that was a situation where there was simply a cash timing issue and the 401k loan was the perfect short-term funding solution. By the way, they got the property, turned it into a beautiful Airbnb that is just crushing it right now. Ended up working out perfectly. Another situation where it may make sense is if you're running into issues with your debt to income ratio or your DTI. So this is your monthly debt payments as a percentage of your monthly income. As I mentioned previously, since 401k loans don't show up on your credit report or affect your DTI, they can be a good option if traditional loans push you over those DTI limits. So that's a breakdown on how 401k loans work. If you determine that this is a good solution for you, your 401k online portal should have a page on loans with information on how to request a loan. All right, moving on to option 2, the 401k withdrawal or distribution. A withdrawal is different from a loan in that you're permanently removing funds from your 401k, which is going to trigger taxes and potentially penalties. If you're under age 59 and a half, you'll pay ordinary income tax plus a 10% early withdrawal penalty. If you're over age 59 and a half, you'll pay only taxes. Your 401k provider will issue a 1099-R at the end of the year, which you'll need to report as income on your tax return. Now, before we dive into the pros and cons of withdrawing money from your 401k, the first question to answer is, can you even take a withdrawal in the first place? So first, you need to look at your employment situation. Are you still employed by the company that sponsors the 401k? If yes, does your plan allow for in-service withdrawals? So this is when the employer allows you to withdraw funds while you're still employed. Now, typically this is only for hardship situations or if you're over age 59 and a half. If you're over that age, then you may qualify for penalty-free withdrawals. If you're under age 59 and a half, withdrawals may not even be an option. And if they are, they're going to be subject to a 10% early withdrawal penalty. Unless you meet an IRS exception, but buying real estate is not one of them. The first-time homebuyer exception is an IRA thing, not applicable to the 401k. So you'll need to check your summary plan description to see who can withdraw and when. Now, if you're no longer employed by the company, then this actually makes things a lot easier. You can take withdrawal from the account because you're no longer in service. But if you're under age 59 and a half, it's going to come with taxes and likely penalties, unless you qualify for an exception, which buying real estate is not one of them. So to simplify this, here's the easiest way to think about it. Are you still employed? If yes, check for in-service withdrawal options in the summary plan description. If no, you can take a withdrawal, but taxes and penalties may apply. I'm not even going to get into hardship withdrawals since we're talking about real estate here, and that is not one of the exceptions. All right, let's talk about the advantages of using a 401k withdrawal. Number one, you have immediate access to funds without any kind of repayment obligation. So this just makes it easier logistically than a 401k loan. You don't have to worry about repayment or what happens if you leave your job. And second, because it's a withdrawal and not a loan, there are no limits on how much you can get out like there is with a loan. You can take out 100% of your account balance, if your plan allows for it, as I mentioned earlier. So what are the disadvantages? Well, you're likely going to have a significant tax hit, which is going to reduce the actual cash available for investing in real estate. And then you have that permanent loss of retirement funds and potential growth of those funds. Unlike a loan, the funds are gone for good, along with any future growth that they could have earned. Now, you may be able to use those funds to achieve growth in another asset class, like real estate, which would be the goal. But to make the withdrawal worthwhile, your new investment will need to generate returns significant enough to overcome the cost of taxes and penalties from the withdrawal. Now, I'm not saying it's not possible. You just need to factor this into your return projections when comparing alternative options. So when does using a 401k withdrawal for a real estate purchase make sense? Number one, if you have a very large 401k balance, think withdrawing a small percentage of your total balance, it's unlikely that that's going to completely derail your retirement goals. For example, if you have $500,000 in your 401k, you withdraw 50 to 100 for a down payment. Even if that investment doesn't pan out, it's unlikely that that's going to completely wreck you. It's very unlikely that that investment is going to go completely to zero. It just may not be as good as the alternative had it been in the market. Another scenario where it may make sense is if you're an experienced real estate investor, you have a solid plan to use those withdrawn funds to generate returns, and your overall financial strategy supports that investment. I've worked with several clients who use their 401k funds to expand their real estate portfolio, and worked out very well for them. Now, these are people that knew what they were doing. They found good deals. The numbers made sense, and it did pay off. Now, I'm less inclined to recommend first-time real estate investors to take this approach because real estate investing is a learning experience, but that is an individual risk assessment that each person needs to make for themselves. There are also some tax situations where it may make sense. For example, if you're in a very low income tax year, those withdrawals may have minimal taxes. Like if you're in a career break or a temporary low earnings year, it may make for a good year to access those funds at a lower tax rate. And then finally, if you're somebody that is just very uncomfortable taking on additional debt and you prefer a one-time withdrawal to fund a real estate investment without any kind of repayment obligations, then that's something to consider as well. May not make sense quantitatively, but from an emotional, qualitative perspective, it may be better for you. And then if you have no other funding sources, you've exhausted all other options, savings, investment loans, home equity loans, and you just need a little bit more to get you over the hump, then a 401k withdrawal may make sense. If you determine this is a good solution for you, your 401k online portal should also have a page for distributions with information on how to request one. So those are your two options for accessing your 401k to buy real estate. Neither is a perfect solution. They all have their pros and cons, like with any decision. So the decision really depends entirely on your own financial situation. If you are considering this, I recommend consulting a tax professional just so that you understand all the implications. Thanks for watching. Subscribe if you found this helpful. See you next time.